Now I am going to tell you something about meaning of financial accounting. Accounting is the process of collecting, recording, classifying and summarizing financial data. First one, the process of collecting. There are so many transactions involved in the business. First of all, you analyze what are the transactions related to finance. So financial transaction only recorded in your accounting notebooks. So the accounting is the process of collecting. Then recording means enter all the transaction in a accounting notebook systematic order. Then classifying means segregate all the informations under one headings. And summarizing financial data. Summarizing means finalize the financial data. They easily convey the result to the outsiders. So, the financial accounting is a process of collecting, recording, classifying and summarizing financial data for the needs of management. So, every business holders wants to know the result of the business. So, we prepare financial accounting to know the result of the business. At the same time, there are so many outsiders also wants to know the result of the business. The outsiders means the creditors, employees, bankers and government. So, we prepare financial accounting to know the result of the business. So, financial accounting involves four steps. The first one is journal or subsidiary books. The recording of financial transaction. The recording of financial transaction, this is the first stage in the process of accounting. It is usually accomplished through journal or subsidiary books. The journal. What do you mean by journal? Journal is a book of original entry. This is a initial stage of financial accounting. In case of small concerns, recording is done in a single journal. At the same time, in case of large concerns, subsidiary books system is used for recording. So this is the first stage of financial accounting. The second one, that is ledger. Ledger is a second stage of financial accounting. Ledger provides a summary of similar transaction at one place. So ledger may be defined as summary of statement of complete transactions relating to an asset, a person, expenses or income which have taken place during a specific period. So journal is maintained to facilitate the posting of entries in the ledger. So every entry written in the journal is posted into ledger in a systematic way. So ledger is considered to be the main book of accounts. For example, purchase account, sales account, buildings account, machinery account. These are examples related to ledger. The third stage of financial accounting is trial balance. The trial balance means the list of all balances standing on the ledger account is trial balance. The last step of financial accounting is the financial statement. There are two types of financial statement. The one is income and expenditure account, another one is balance sheet. The income and expenditure account. We prepare income and expenditure account to know the result of the business. The result means trading result of the business. The trading result means profit or loss. How do you find out profit or loss? The income over expenses is profit. Expenses over income is loss. For example, income rupees 1 lakh and expenses rupees 80,000. What is the difference between income and expenses? Rupees 20,000 is called profit. At the same time, the expenses rupees 1 lakh and the income rupees 80,000. The difference rupees 20,000 is loss. The next step of the financial statement, that is balance sheet. Balance sheet is not accounting format, it is a statement only. You prepare balance sheet as on the particular date only. To prepare balance sheet to know the financial position of the business. Financial position means the business position of the business. That is assets and liabilities values. Assets mean there are different headings. The assets are involved in the business. For example, fixed assets, current assets, fictitious assets, etc. You prepare balance sheet, know the result. How much rupees in fixed assets? Then how much rupees in current assets? At the same time, liabilities. Liabilities, although there are different headings. The one is internal liabilities, external liabilities, then long-term liabilities. Internal liabilities, that is owner's fund. For example, the capital, reserves, P&L account, etc. The external liabilities means outsiders liabilities. There are two. That is long-term liabilities and short-term liabilities. The long-term liabilities means, for example, the debentures, long-term financial loan, etc. The short-term liabilities means current liabilities. It is easily converted to cash. We pay within 1 year. The type of liability is called current liabilities. For example, creditors, bills payable, outstanding expenses, etc. So finally, you prepare balance sheet, know the financial position of the business. So finally, the financial accounting means record all the transaction in a systematic manner. That's all. Thank you.